What's up, investing legends? Today we welcome Adriel Hsu to the program. Adriel's path into real estate started in the last place you'd expect, an oil and gas job. Fresh out of Georgia Tech with an environmental engineering degree, he was shipped off to a small Texas town in 2016. And within his first days on the job, he knew he didn't want to spend 40 years behind a desk. So he started hunting for a way out. After cycling through e-commerce and dropshipping, he landed on real estate and then spent the next 5.5 years grinding 2 full-time jobs at once. 9 to 5 at the office, 5 to 9 on his real estate deals, before finally walking away from the W-2 in 2021 and never looking back. Today, Adriel runs a residential development business in Houston focused on land splits, entitlements, and ground-up luxury construction, the higher end of the market where he believes the spreads are actually worth the effort. We kick off the episode with Adriel's origin story and how a guy who just wanted a brand new house without paying market price taught himself to find land, split the lots, and build it himself. Later on, we dive into the mechanics of his development model, how he sources off-market opportunities, why he abandoned thin-margin starter homes for the luxury market, and how he structures deals with private investors. To wrap up the episode, Adriel shares his read on the Houston market heading into the second half of 2026, what's really happening across office, multifamily, and self-storage, the importance of staying flexible, and the one investing secret he's lived by for the last 10 years. So if you're looking to understand off-market sourcing and how to build durable, conservative returns through real estate cycles, this episode delivers practical insight from someone who's been actively finding, building, and deploying capital deal after deal for over a decade. So without further ado, everyone, let's welcome to the show, Adriel Hsu.
Welcome to the Investing Secrets Podcast.
Adriel, welcome to the vault.
Thank you for having me on.
Yeah, man, I'm excited to chat with you. You've got an interesting background here, started in oil and gas as an engineer, got sick of the W-2 life, and made some headway in the real estate investing space. And am I summarizing that correctly? I think so.
Yeah, basically, more or less.
Yeah,
that's
awesome, man.
What happened?
Awesome. And now you're doing some ground up residential, single family, all parts of the process, right? Lot splits, entitlements, and also just working on development deals as well. So
correct.
Very interesting background. Would love to hear like
definitely
the Spark Notes background of your journey here.
Yep. So once, I graduated college, I got my degree of environmental engineering from Georgia Tech, and I was thrown right into an oil and gas job out in Texas. So I moved over to Texas, and, off the bat, I knew I didn't want to do this for 40 years, right? The whole going into the office and just working away on the computer. So I looked into side hustles, I looked into e-commerce, drop shipping, all those things, but I'm not too tech savvy. And only thing that really made sense was real estate at the time, right? It's a very simple concept. Hey, buy it for this price, add value to it, and it's worth more money. So long story short, I, just dove in on real estate, listening to podcasts, learning however I could, YouTube, and just started taking action on finding deals. And that's what sparked my real estate journey, all while I was still working my 9 to 5 day job.
And how long did you have to juggle that for, man?
Yeah, so I kind of started both at the same time in January of 2016, my first full-time job out of college, plus getting into real estate. And it wasn't until summer of 2021, so 5.5 years essentially, before I finally walked away from the day job to do real estate full-time.
A lot of people would burn out or kind of give up, right? Because it's like a 5.5 year process. It's not easy. So talk to me about some of the challenges with that, because there's a lot of listeners, I'm sure, who are doing that right now or thinking about it.
Right. I mean, it's definitely work, right? It's working 2 full-time jobs essentially. And, luckily I was young in my 20s and had the energy, had the time to do all that. And I was pretty fortunate at my day job. I didn't have too much of a stressful role. I mean, I was fresh out of college. They were just kind of like, hey, just give him the easy stuff. He's not really, experienced in oil and gas, which worked out for me because I didn't have to stay overtime, stay late like some of my colleagues. And I had the time to go home and work on the side hustle, which was real estate. So that kind of helps. I know some people have actually very demanding, day jobs where they're physically and emotionally just drained after work. I didn't have that issue. And I just, spent my time to focus on my day job. My real estate, because I was in the middle of nowhere. I was out in Beaumont, Texas, which is about an hour and a half east of Houston. Didn't know anyone out there, no friends or family out there. So my spare time was just dedicated to, hey, finding a way to quit the day job, essentially. So that's really go to work 9 to 5, and then 5 to 9 just working on real estate. Weekends working on real estate.
And when you say working on real estate, right? There's people have so many definitions of that. So what was the gateway, right? Entry point, and how did that evolve over time?
Right. So, I first came across BiggerPockets.com back then. That's what a lot of people first, get their exposure to real estate, started listening to podcasts, and, I said, all right, let me find an off-market property. Because the only thing I really learned is, hey, I need to get it at a good price, under market value. And really the only way is to get it off-market, not on the MLS, essentially. So that's what I focused on, learning on how to market to sellers off-market. And that eventually translated, past single family to multifamily, to commercial real estate, to land. So I think that was the biggest key for me, was I was learning everything I could about off-market marketing.
Got it. So what was the game plan though, right? Like you were going to buy this property and do what with it?
Right. So, on BiggerPockets, they preach a lot about the BRRRR strategy, the buy, rehab, rent, refinance. So that was my first idea. Hey, I'll start out, buy a single family home, rehab it, rent it out, refi, and repeat the process. But after I did my first deal, I was realizing, hey, a couple $100 a month cash flow on a single family home is really, not really going to do much in the bucket, right? In terms of being able to quit the job. So that's when I kind of realized, hey, I need to pivot. And that's when I started doing more flipping of single family homes. And at the same time, I was looking into multifamily, because I knew, okay, the economies of scale make sense when you have multiple units on one site. So that's kind of a really quick summary of my initial years. Was did my first deal. It was a BRRRR deal. Realized it wasn't worth, just one tenant on one property. And then I started flipping houses to save up money to go buy an apartment complex.
Love it, man. So you went from BRRRR to flipping to trying to buy some apartment buildings. At what point did you decide to kind of venture into entitlements and residential construction?
Yeah, so that wasn't until 2021. And so the first, 4 years of my career was just single family flips and wholesales, and then buying small multifamily. Not syndications. I was looking at, under 30, 40 units, the smaller ones, as my, idea was, hey, all the big syndicators are going on the 80 unit plus where they can have on-site management, while these mom and pop ones that are smaller units aren't just getting as much attention. So there was less competition. And, that was my focus. And then, as 2021 was red hot for multifamily across the board. And then once 22 started, you started to see the cracks. And I guess the last 4 years now has not been great for multifamily, for syndications, right? That's where I pivoted, essentially, was in 22 or 21. I said, hey, let me look into new construction. And it actually stemmed from, I'd quit my job, the oil and gas job, in 2021, right? And I knew I wanted to move out to Houston, to the bigger city, because I was an hour and a half away, small tertiary market. And my first 2 primary residences, I bought them and fully remodeled them and lived in them. But there's still certain issues with older homes that kind of annoyed me. So I was like, all right, I want my next home to be a brand new built house. However, I was so used to not paying market value. I said, how can I get a brand new house without paying the market price? And that led me to figure out, hey, I got to build it myself. So, and then the economies of scale from the multifamily side was like, hey, I can't just build one house. let me find some land, split it up, and build multiple houses, sell the other ones off, and basically get my house for a deep discount. And that's kind of what I did. I found a piece of land that I could split up into 4 individual lots in Houston and build 4 homes. And I built 4 identical houses, sold off the other 3, and I basically got my personal house to live in for almost zero, essentially.
Wow. Interesting. Yeah, I was about to say, well, it's hard with new construction on an individual house because you don't have any economies of scale. A, B, everything is cost of labor, cost of goods. Everything has increased pretty significantly over the last decade. In terms of construction. So that's a very interesting and novel way, though, to get your house for free. Do you still live there? You still
I still live there. Yeah, so
awesome.
I got the land in 21. My first build, so I made all the mistakes. It took longer than expected, and I didn't really move in until 2023. And I've been here the last several years. Yeah,
I mean, 2 years isn't bad. Like 2 years is it's pretty solid for ground up. So that's awesome, man. That's really cool. That's actually like a really awesome story. Not too many people can say that they built the house that they lived in, that they live in, that's pretty rare these days.
Yeah. So just having that mindset to always try to find a deal or find a way to get a deal is kind of how I approach real estate.
Yeah. Well, now, so what's the largest parcel, or like how many lots? What's like the largest lot number that you've kind of divvied up for sale?
Yeah. So I did one where it was a 1 acre lot, but it was inside the city of Houston. So it can have very dense zoning, and I was able to split that up into 20 lots inside the 1 acre.
Oh, wow. So this is townhomes, right?
Yeah, these are kind of townhome style. They're 3 stories tall, no side yards, no backyards, etc. But it's in a part of town where you're going to sell them at a lower price point for someone that just wants a house, right? They don't care about having all the space. They just want something to own instead of always renting. But I sold that out. I split it up, and I actually sold that without the plans or permits or anything. Just split the lot and sold it to another investor. As just what I've realized is those lower price point homes, it's just so hard because the profit margin is so low, especially here in Houston. You have new construction homes selling for $280,000. It's, very tough, even if you're scaling up to 20 houses, to really make good profit on them. And that's kind of what eventually led me to go to the higher end market, where the spreads are worth, I guess, the effort.
Well, I mean, since you're in Houston, you probably know more about this than I do, but in the commercial world, which is, I spend a lot of my time now on the commercial side of things, the prospects of the market of Houston is there's I think conflicting reports that I've received. Like there's some people saying like, oh, it's still doing okay, it's still doing well, and then others that are saying no, it's doing horribly. And so
I'm in that boat.
What's up with Houston? What's up with Houston?
I'm definitely in the commercial side is not doing well in Houston.
Yeah. Okay.
I mean, it depends on what asset class, obviously, right? Office space is terrible right now. In Houston, there's a million offices out there. I guess, if you have like a strip mall, a little strip center mall, which is very popular here in Houston, depending on the location, you probably will do okay. Multifamily is not doing so hot, because there's been so much new construction on Class A apartments since the COVID boom that rent growth is probably negative. People will say it's stagnant, but I mean, I have a 21 unit complex near the heart of Houston, and my rents have been stagnant to try to even just keep, high occupancy. And there's just so many options. A lot of the Class A new ones, they're giving out concessions of like 8 weeks
massive
free.
Concessions, yeah.
Yeah, massive concessions. And it's been tough because you also have a lot of those build to rent people building now. And then you also obviously have D.R. Horton, Lennar building those massive communities in the suburbs for starter homes. And a lot of them aren't selling, or people just buying as rentals. So there's so much supply, at least in the multifamily space, that multifamily is not Combine that with the property taxes and property insurance in Texas along the coast skyrocketing. So your NOI is just going down every year, technically. I mean, people are finding ways to kind of stay afloat, but I wouldn't say it's things aren't getting better yet. I've talked to some brokers, and they're seeing some appetite for the smaller multifamily, but a lot of the big, institutional grade assets are still not doing so well. Multifamily or office or even self-storage for that matter. 2021, when everything was still hot because of the rates, right? I actually wholesaled quite a few self-storage facilities. I wholesaled a 235-unit self-storage north of Houston, and there was appetite. People were buying, but then all that dried up as well. And of course, I'm sure you've heard there's been so many foreclosures on multifamily in Houston. All those people buying with bridge debt in 21 and 22 have just gone underwater. So it's maybe other markets have been, recovering better, but at least here in Houston, Austin, Dallas has not been so good.
So you kind of just glossed over this real quick, but this is interesting. You just wholesaled a bunch of like self-storage facilities. Talk to me more about that. I'd like to kind of hear the process. How did you identify those? And what was the process by which you found the end user for that as well?
Yeah. So, I mean, like I said in the beginning, once I learned how to market off market to get, direct to sellers, that's always my, I guess, motto is like, why am I paying market value, right? I know commercial is a little different. You network with your brokers and you get your deals, right? But to me, I'm still like, hey, you're still paying market value, essentially. You might get pocket listing from the broker or whatnot. So I ended up doing my own thing where I, started reaching out and marketing to commercial owners directly, whether that be multifamily. But that's how I bought all three of my multifamily properties, was just direct to seller. Because I have a 14 unit, a 21 unit, and a 32 unit multifamily. And I just applied that same thing to self-storages. I was seeing multifamily was way too hot, and all the sellers were wanting, premium pricing in 2021 because the market was just on fire. So I pivoted. I found some self-storage mom and pop owners that are ready to sell. And I was seeing actually multifamily buyers wanting to buy self-storage. I guess the yields and the returns were, at least on paper, looking better and less headaches, not with, real tenants in terms of living there. So I started seeing some demand grow up for self-storage. And, people say self-storage is pretty recession-proof as well. Once people downsize in a recession, they need somewhere to store their stuff. So I was just seeing increased demand from traditional multifamily buyers along with normal self-storage buyers. And I said, hey, let me try to market, find some seller that's owned it for 20, 30 years, willing to let it go, and then just wholesale it. For me, I thought about taking it on myself, but I said, man, I know how to manage multifamily. I don't know how to manage self-storage. And one asset is really a headache. You want to have multiple assets to really scale up. So I just decided to, sell them off as a wholesale, make some money, and then be on my way. Yeah,
that's awesome, man. That's really cool. A true real estate entrepreneur, making money in real estate in a variety of different ways. I mean, look, like that's the game, right? When you start peeling back the layers in real estate, I mean, once you get good at it, or once you understand it, there's a lot of different ways to make money, right? And so if you, obviously we were talking about this offline before, but you and I look way younger than we both are. Like, we've both been in this game for now, like, over a decade. And it's pretty awesome. Like, now looking, I'm like, oh my gosh, like, there's just so many different ways. Now, staying focused, right? So in your world, I'm on the finance side, right? So all of my everything that I do is like, debt, equity, finding investors, doing that whole thing. But you're like on the acquisition side.
Exactly.
Right.
Essentially.
And so that's or you were, at least. Now maybe you're doing acquisitions plus some development, right? So you've got maybe two arms there, but you really got to refine and niche down, because someone hears what I do, right, which is help real estate investor or real estate sponsors and developers find investors for their projects. They're like,
Right.
oh, that sounds awesome. And then they hear what you do, right? And they try and do both. That's when you start. That's a recipe for failure. It's a recipe
Exactly.
for like absolute catastrophe, because you will be spread too thin and you will bust out.
Yeah.
You're not going to survive.
Exactly. I didn't, learn everything at once. I was doing the flipping thing, got that kind of automated, not really, right? But I just knew all the processes, then bought the multifamilies, had a good grasp on that. And that's what I said, all right, let's try self-storage. Then let's try new construction after I've already mastered, like you said, the other ones. And I think being able to pivot in real estate is very important as the market will change. Obviously, syndications for multifamily has been really rough the last 3 to 4 years. And if all you knew was how to do multifamily syndication, you weren't doing deals or making any money for a prolonged period of time now, just because the market has shifted for multifamily, at least here in Texas. So I think just being able to be flexible and pivot to a different strategy in real estate is important for longevity, because a lot of people can start real estate a couple years, but really, like you said, going 10 plus years is a different ball game, right?
100%, man. 100%. Speaking of which, Adriel, like, what do you think has allowed you to, like, longevity is something that I don't think gets talked about often enough in business in general, in entrepreneurship. I've seen a lot of guys fizzle out.
Yep.
I've wanted to fizzle out before.
Yeah.
But I just won't fucking give up.
Exactly.
And I'm so relentless. I just fucking will not quit. But I don't think that's a good enough answer. Like, what are the things that you've done? Right? Like,
some concrete examples.
Yeah. Like, can you point to anything that's like, this is allowed me, the longevity to do what I'm doing right now?
I think first is being conservative, right? I've always been kind of extra conservative on my underwriting, and that's probably, during 2016 to 2021 cost me so much money because everyone else was, hey, screw it, I'll buy it, market's going up, and I'm seeing people make crazy money on flips or syndications where I'm like, oh no, that deals are too tight. Because, I've always taught on BiggerPockets, don't bank on appreciation. If it doesn't cash flow day one or whatnot, appreciation is just a bonus. But then we realized how much appreciation happened over the last year, decade. I'm like, dang, I could have bought all those deals I passed on. But the flip side is now the last 3 years where people have lost so much money on flips with the market shifting, or their multifamilies are being foreclosed on and they're losing investor capital completely because the deals went underwater. I'm glad I was so conservative in my numbers because all my projects are, like my apartment complexes, I still bought them way under market value at the time, where I can hold on and just weather the storm of low NOI and not lose my investments. So I lost out on, making crazy money in 2020 and 2021, but I'm not losing a lot of money just by being conservative. So that's always been like my first motto, is just underwrite super conservatively. And in terms of pivoting, I'll give you an example. So when I first started in 2016, direct mail was kind of the go-to method to marketing to sellers. And I was sending out direct mail. And then end of 2017 is when finally there was cold calling systems where like actual dialers we can call sellers. And that's when I pivoted to cold calling because I saw my cost of marketing went down. And then 2019 SMS messages, were popular. And I wanted to switch to that. And I've tried like PPC and Facebook ads, didn't really do so well. But just being able to pivot. And now I've been doing cold calling since 2018, but there's been new regulations on, talking to people, spam/harassment. So I'm now looking into AI for handling a lot of my things, because right now they have AI voice agents that sound like a real person. And I'm just looking at using that to cut costs or whatnot. In terms of calling back sellers. So I had problems before, like someone would reach out, they're interested in selling, let's say from a Facebook ad, but someone on my team couldn't get to it until maybe later that day, just 3 or 4 hours later. But by that time, someone's already looking at 4 or 5 different companies. So now there's AI, I guess, companies where an AI voice call will call them back within 10 seconds of when it comes in. So I haven't integrated that yet. I'm just, I've talked to some companies, heard their pitches, and I'm looking into it. But just always having an open mind on trying different strategies out and pivoting helps keep your longevity going, because in real estate or in marketing in general, trends shift, technology shifts. You can't just be stuck on one method and not want to adapt or learn or grow.
I totally agree, man. And I think so before all this, I was in residential real estate. I was a residential agent, and so I I did a lot of cold calling kind of like early on in my career. And it's crazy, things have shifted so much now. When I first started, people still picked up their phone. But I think the biggest issue now is that like there's so many spam filters and this and that. Like it's really hard to, unless you're calling like an old retired person, which could be your core target demographic. Like those people just don't pick up their phone anymore, right? For callers.
I'm the same way, right? Yeah, I prefer getting a text so I know at least what it's about or who it is instead of picking up a random number. Yep.
One of the greatest marketing pieces of advice I ever received in terms of marketing is, if you want to know whether or not your marketing idea is going to work, audit your own behavior, right? And ask yourself how you would respond to that form of marketing. And that's when I stopped cold calling. Was when I realized it's like, oh shit, I wouldn't even pick up the phone for me. Right. And then I audit myself when I get duped by somebody and I do pick up the phone, I'm hanging up on them in like 5 or 10 seconds. And I'm like, dude, if I can't build a business on a marketing model that I myself wouldn't subscribe to as a consumer.
Exactly.
Right. So I hear you. And that's cool. So inbound leads, you're trying to come up with some cool, creative, AI, solutions to increase speed to lead.
Yep.
Yeah. That's awesome, man. That's awesome. And I'm assuming though, you're concentrating rather on, the Houston MSA. For all of your real estate holdings at this point.
I'd say I'm all over Texas. For buy and holds, it'll be in the Houston MSA, but I'm marketing in Dallas, Austin, San Antonio, Beaumont, Texas. I'm all over Texas, essentially. I mean, I've done deals outside of Texas. I've marketed some in California. That's where I was born and raised, and my parents still live in SoCal. But
sweet.
Tough market out there. So, so that's like maybe 1% of my marketing, nothing too crazy. But yeah, mainly just all over Texas in the major metros.
That's awesome, man. Well, Adriel, as we start to come up on time here, a couple last minute things to chat about. Where do you see the residential sector heading now over the next 12? Obviously, we don't have a crystal ball, right?
Right.
No caveats here. Like there's caveats that we don't really know, but how do you see this all kind of shaping up? Because we've got a lot of moving parts right now, and things are wonky.
Yes, things are definitely quite wonky. Everyone expected the rates to come down a lot sooner than they have. They're not too high right now, but I think it's just going to be stagnant, at least in Texas. I'll speak for Texas only, right? Because I know other markets like Chicago is on fire right now for residential real estate. But at least here in Texas, we've just built so many homes over the last 4 years. All the big builders, Lennar, D.R. Horton, due to the lack of regulations in terms of house building, we've gotten the supply up to meet the demand, and we actually have passed the demand now. So it's more of a buyer's market in residential. So great time to buy if you're looking to buy a house in Texas, but not a great time as an investor. I don't see appreciation going up. In fact, I've really seen depreciation in the values all over Texas, probably around 10%. Homes that were selling for $400K in Houston a couple years back are now selling for $370. So, a lot of it's bad in terms of the supply. And that's why I stopped building homes in the starter home range, because we've been flooded with D.R. Horton and Lennar, and now they're trying to offload their inventory. They're offering a lot of incentives. They're giving their buyers, like, last time I checked, a 4% interest rate. And,
if you do the loan with them.
Yeah, so and all these like concessions to get people in their houses, which
Yeah.
a small operator like me, I don't have that power.
Yeah,
and that's
course.
kind of what shifted me to the luxury side. Is my philosophy is no matter downturn or not in the economy, the people with money are kind of still, they have money, right? It's, they might tighten up a little bit, but if they like a house and they want to live there, it's not really going to affect them. 8% interest rate versus a 4% interest rate. So, and the returns are there. I'm seeing, at least off my underwriting and from my deals I'm doing, maybe 40 to 50% total return over a 18 to 24 month project. So annualized, you're like, and that's if I have it with an investor. So how I do my deals with my private investors is a 50-50 split in equity. And then the bank construction loan will obviously have the first position lien and all that. So, and my bank would normally loan 80% loan to cost on the whole project. So if my whole project, let's say, costs 1.5 million, the bank will give me 80% of that. So 1.2, right? And then let's say I raise 300K from my investors and the house sells for 2 million. Let's say net's at 1.9, closing costs, realtors, all that stuff, holding costs. So say worst case 350K net profit, being conservative. Half of that 175 goes to my investor who brought 300K. So that's a little better than 50% total return. And let's say a 2-year turnaround. So half that. So look at 25-ish, mid-20s, high 20s annualized return. So a lot of investors are chasing yield right now, right? Because multifamily was providing the yield from the appreciation. Because even through the 2010, 2011, 2021, they weren't cash flowing on multifamily. It was all the appreciation and the exit. And that's why the syndicators were going full cycle in a year and a half, 2 years to hit those returns. But now that syndication and multifamily has kind of been in a rut, I'm seeing investors chase yield in other projects and they don't want to be tied up in a long-term deal now. I think a lot of investors went to a syndication. Now they can't exit their apartments and they've been sitting there for 4 years, 5 years with no end in sight, right? So these guys like the new construction model where, hey, okay, 1.5 to 2 years is enough time where like the percentage on your return actually does something, but still short enough where they can get their money out, essentially.
Makes sense. Yeah, because you're right. To your point, a lot of the real estate, the private real estate investments that are like more syndication models, where you're achieving those high teens, low mid 20 returns. The lockup is usually 5 years. Right? So what you're saying is that you can achieve the same return. You could achieve the same return percentages
in 2 years.
In a 24-month period, right? So obviously the MOIC or the equity multiple is going to be lower, but that's because it's only a 2-year hold. So but then they recycle it. And you close and you probably have that next deal lined up for them, right, bro? So
that's the point. That's the goal.
You have you single, married?
Married, yes.
Married. Okay, I was about to say, I had a joke for you on the realtor fees. I was like, oh, dude, that's easy. Just marry a realtor.
Exactly. Right.
But anyways, man. Cool. Well, Adriel, it's been awesome, man. Great getting to know you.
Thank you, Danny. Likewise.
And hope nothing but the best for you. Before I let you go, though, a couple last things. If people want to connect with you online, follow your journey, where can they find you? What's the best place? Where's the best place for them to connect with you?
Yeah, so social media, I'm active on YouTube, Instagram, TikTok, and they're all just my name at Adriel Hsu, Adriel HSU. If you search that on YouTube, Instagram, TikTok, I should pop up. And I'm pretty active. I post a lot. I post in-depth numbers on all my deals. So yeah, if you want to reach out, my email is in the links in all my socials, I think. So you can shoot me an email, DM me on one of the social media platforms, and that's probably the best way to get a hold of me.
Love it, man. All of those links will be in the description and in the show notes. Adriel, I can't let you go until you leave the audience with one final investing secret. Take it away, my friend.
Yes. My secret is what I've lived by my all 10 years is always be conservative on your underwriting. I mean, if you're an investor looking at a syndicator to invest your money in, ask them for worst case scenarios, ask them for the most conservative questions you have. And that's for those operators out there, always underwrite worst case. I've seen a lot of syndicators look at their cash flow projections, their IRRs, and it's like, man, you're not going to get 7% 7% rental increase every year on year. Like, so my thing is always be conservative. That will save your butt no matter what, as an investor, as investing money, or as an operator.
Yeah. And it takes a lot of discipline.
It does.
And what you're saying takes a lot of discipline, and it does. There are a lot of wishful thinkers out there. I think the hard part, especially when you're getting started, right, to not kind of overreach. But kudos to you, man, for developing that discipline early on in your career, and wish you nothing but the best moving forward.
I appreciate it, Danny. Thank you so much.